Hey, listeners, welcome back to the ValueHunt podcast. And today I'm truly excited to be here with Dennison Hambling. He's the CEO of IMG, Intelligent Monitoring Group. And full disclosure, I'm a shareholder for a long time, so I'll probably be very biased in this interview. But anyways, let's try to be objective and ask the right questions. So, Dennison, why don't you say a couple of words and maybe explain a bit of what IMG does for the newcomers, I guess.
Yep. Fabulous. Thanks, David. Really appreciate the opportunity to chat to everyone. IMG is Australasia, so that being Australia and New Zealand's largest security monitoring and services business. We've been effectively listed for a number of years, but we're reverse listed of a very small business that I got involved in about early 2020. Security monitoring is essentially, signal alarm, burglar alarm monitoring. Most of our customers are actually commercial. People tend to think of us as residential, but we tend to skew actually more commercial. And we are the biggest player. I think probably the notable feature, David, probably around when you would have got involved in us, was when we bought the ADT business in Australasia. And so in the markets, we trade our customers and us as either ADT or Signature Security in Australia. And we have a wholesale monitoring business called IMS, Intelligent Monitoring Service, and that all comes under the IMG group, and I manage the group. When I took over the business, we were essentially a failed collection of a few different assets, which were a number of little control rooms, and we've pieced those together with a new operating platform, a leading operating platform, which has allowed us to grow our presence from being a very small company to about $200 million market value business today with around $80 odd million of debt. We service about 200,000 customers around Australasia, which is either a lot or not very many, depending on where you come from. The truth of the matter is, and the real, guts to this business and industry and thesis is that the market is in Australasia been behind the rest of the world. There hasn't been a leading security services business in this part of the world for a number of years. By bringing the assets together and the brands together that we've brought together, we're looking to remedy that. And then we're now looking to accelerate with the latest technology globally and actually go from being behind the world to at the same pace as the world, hopefully even ahead of the world, and grow and remedy our low penetration for security services in Australasia up towards more like US and European levels of uptake for monitoring. So it's probably good. I'm not sure if it's a good summary, but it's a summary for you, David, of who we are.
Yeah, I'm sure it helps people that never heard about IMG. Actually, you have loads of questions from the audience because, a lot of my audience happens to also be interested in IMG. So I'll jump into the questions from the audience, and then I have a couple of questions from my side. Hopefully, we can go through all of them. The first question I have for you is: how do Wilson Securities, Chubb, and IMG differ, and who's winning, losing market share, and why?
Yep. So the first one I'll deal with is Wilson. So Wilson's here is in this part of our world has got quite a lot of brand presence. It started as a car parking business, so it's everywhere in Australia and New Zealand as a car parking operator, and then they branched off into physical security, so guards and cars. So you see them around a lot, but we don't really see them as a competitor. We're in the electronic part of the market. We're trying to basically do everything we can that's security that doesn't involve labour, if I put it that way, or at least repairing labour. So they're very big by presence and probably number of people and even maybe top line, but they're not really someone we run across at all in our interactions. And to be blunt, they're probably one of the companies we're looking to disrupt with our latest video guarding technology. Chubb would be our most like competitor in Australasia. Chubb's fire and security. One of the differentiators would be they are far more fire than security, so they do a lot more building, fire monitoring, and servicing and installation than, say, security. But equivalently on the security side, which is all we really do at the moment, we would line up a little bit smaller than them today. Obviously, we've come a long way in the last year, so we're gaining them pretty quickly. but they would be our most direct competitor. They have a monitoring room probably of the same platform that we are on, same generation of technology that ADT has been on, which we are now, updating and, bringing up to, leading global standards. We don't tend to come across them very often, if I'm being honest, but they're in the same part of the world. Probably the other players' names that people would know, Securitas is in Australasia. It's not particularly big. It bought a beachhead sort of access, starting asset a few years ago, and probably one or two others. But it is in our market, albeit small, a little different than maybe in Europe. It's a bit more, or at least my understanding perspective of it is it's more a few commercial, or I'm sure there's a lot of commercial customers, but commercial customers. Outside that, CCOM, a big Asian company, would be here. And then got some of your old names. Honeywell is still active in the commercial enterprise end of our market. And then it's very regional. So from there you become, East Coast sort of broken by state or regional competitors. And I think the real point underlying all of this is that it has become a very fragmented market, and there's rooms for everyone. It's a big market. We think security services is a $5 billion plus market in Australia, and then obviously add another fifth sort of in size for New Zealand. But there's no leader today. And this is possibly a little bit the same everywhere in the world. I think Europe is different. With Securitas has got quite a good footprint through Europe, and Verisure has also got a pretty decent footprint. In our part of the world, 15 years ago, Chubb, Honeywell, and ADT would be like the PricewaterhouseCoopers, Deloitte sort of equivalents, of depending on which markets you're in, live in. But the professional service security guys, that leadership doesn't exist anymore. So our whole drive, if you are a large scale national customer, so you might be a big retailer or an airline or an airport or a industrial packaging business or waste business or whatever, at the moment it is very hard, or a bank, to have a national provider of security services. That doesn't tend to exist much anymore. So our first thesis for growth that we've been accelerating strongly and doing well with has been, let's get a national footprint back. Let's actually be the ones to have a national footprint. Mm-hmm. And so all of the acquisitions of the last 12, since we bought ADT, have been about growing our footprint and accelerating our highly skilled technical people on the ground to allow us to take national work, which comes, gives efficiencies for the customer and better value for us. And we're finding that to be very successful. And then the second phase will be using that footprint to drive the latest technology opportunities into the market and go bigger. So, yeah.
Perfect. So maybe only focus a bit more on the part of the question, like he also asked, who's winning, losing market share, and why. Mm-hmm. So maybe you already touched a bit on this, but if you could give a bit more flavor on that.
Yeah, look, I don't perceive, I'd have to say I think we are the leader in this market, is my perception. Now, obviously you're biased, but we are listed. We have a very clear focus. We're very transparent. We're very obvious in the market now. We've come from not much. We bought it. The buying of the ADT asset was a key, industry change moment in Australasia, and we've taken that from 2 million of revenue to, over 5 million of revenue a month now within the first, 18 months of ownership of ADT. So I always tell an analogy on that. When three years ago, when I first went to the industry conference in Australasia, I turned up, and it's actually quite large. Like, it surprised me how big the industry was, and we were nobody. The second year I turned up, the second time I went, we'd just bought ADT, and suddenly we were somebody, and everyone's like, oh, and I was like, oh, wow, that's a good brand to have on your T-shirt. And then the third year that I turned up, I was giving the keynote speech at the conference for the whole industry. So in terms of movers, we really are setting the pace, I believe. That being said, there are a couple of, I don't disrespect, we've got good competitors. They just don't have the footprint, and I think some of the advantages that we now have I would say Securitas would have to be somebody you'd have to expect to do well, given the global strength they have. I think there's a business called Sapio, which was half owned by Telstra recently, which has gone back into private hands, which is doing, I would imagine, will do well. I think they'll be well positioned to do well. I think CCOM has always been strong, but then I think some of the older names are struggling. I think some of the older names will probably find it harder and harder. Chubb, and some of the Honeywell, some of the older guys, they've got a lot of resonance and been around and are safe, but I think technology, potentially is a challenge for them. So it's a mixed environment, but I don't think anybody stands out. I think we are setting the pace at the moment.
Mm-hmm. Okay, got you. So I have a bunch of questions on how you will compete with Chubb and all that. I already understood Wilson is not exactly the perfect competitor because not exactly the same business, but you also got a new board member who worked for Chubb's. So any insights on the competition strategy? How does it compare to IMB? So just interested in knowing more about like the new board member and also what's the competitive advantage, or how is IMB trying to compete and differentiate itself from the other competitors aside from technology, maybe?
Yeah, look, I think at the end of the day, this is a service business. So ultimately, success only comes from actually delivering a really good service that works at a price that people are prepared to pay and does the job. I think you can't get away from technology as a differentiator. I think the reason the industry was in the shape, and it got into the shape that I think it was in when I joined it, was because they had fallen off the use of they'd not kept up with technology. So Chubb, ADT, all of the big monitoring room players were operating off very old operating platforms. So I liken it to like 1980 telco platforms, sort of pre-wireless era operating systems. And so I think that was a real problem. I think none of the large part of the industry had adopted and really aggressively looked to use video in security. And I think fundamentally that is the key driver. Like fundamentally understanding the role of video, not just for security, but how you can also apply it is a standout difference. And so right now, I want to be cautious because I don't expect us to have it forever, but I think we do have a technology advantage over our major peers. I think we have brought our control rooms up to standard and are able to take on modern technology. And what I mean by that really is connecting to cameras and IP devices. That has traditionally been difficult to do on the older platforms. And then I think we've introduced new technologies, edge AI type technologies in particular, which have made it possible now to essentially turn your control rooms into live monitoring stations. And I think I'm sure everybody will go down that route. It is a slow to change industry generally, and I've just been a week ago up into the global conference in the US, and I think that comment is probably consistent actually through the rest of the world. But I think that advantage that we've worked hard to get over the last 3 years by actually investing fundamentally in our platforms, and then finding the best technology to connect to us creates an advantage. And I think the really big disruption advantage is video. And by the use of being able to use video in a fairly centralized fashion allows you to change the economics fundamentally of security and what we're looking to do there. I think that there's two real parts to the technology that we offer, and probably what I'd encourage people to think about is, I tell a story. Security back in medieval times was having a moat around your castle and having a couple of big guards, with swords to keep people out or deal with them if they got into your property. That was the model for security for a long period of time, really, until technology came along. The use of technology in the first case was access control. So we can now know who is on the property and who is off the property. And then we can then monitor that as well.
Okay, cool. So yeah, now we'll go a bit more into financial performance and subscriptions and all that. So just curious to know, how is subscription revenue growing given the economic slowdown? I don't know if economic slowdown means USA slowdown or Australian slowdown, but yeah,
Yep.
just curious to know how that's going.
Yep. So look, at the moment, the Australian economy is still chugging along okay. We've got an election coming up, so we're not seeing any real economic impacts here yet. The effect of the tariffs and all that noise overseas is relatively low for Australia. New Zealand has been in a recession, on and off really for the last year. We have seen a tougher environment there. Look, fundamentally, a tougher environment is not necessarily bad for our business. So on the pure security side, it does tend to correlate that people get more concerned about protection and there is more, crime and what have you in tougher times. So if anything, we think we probably are defensive. I don't think we did a lot of analysis on the long-term data series when we bought ADT. And we didn't really see any correlation to economic environment in our subscriber numbers fundamentally. So that's okay. I think in terms of growth, now we are finally, I think we have to characterize the first year of owning ADT was around turning it around and cleaning it up. And we also had to go through the 3G upgrade in Australia, which was a huge amount of work for the business to get done. It's really only now that we're starting to get clean to look to growth and actually bring on customers. Our strategy around the customers we want now are probably a little different than in the past. We're looking for high value camera, high margin, high returns customers. And, we're really excited by what we are seeing there. It may mean that our total customer numbers don't grow at the same rate that our revenue and profitability does. Because of the sort of the focus that we have. But we've got a very stable and consistent business. We certainly aren't seeing people churn off because of the environment or anything like that.
Right. Yeah, I also had like a follow-up question on this, but probably you already answered. Just want to understand better. So basically, in a recession, nothing critical should happen to revenues and margins, right?
No, I think the thing I'm aware of is we are now in our commercial enterprise business, we are now starting to look at quite large upgrade and retrofit and improvement projects as a nature of that business. And I think if things, some of our revenue growth that we are looking to, could get affected by timing decisions for businesses. So, to give you a hypothetical but somewhat real example, we do a lot of work for an major airline in Australasia that flies around the world, and we look after their security around the world. And so that is access control and monitoring and everything that goes with it for their electronic security. They would like to do a major upgrade of all of their systems, which would be a big piece of work, probably over a year or two.
Yeah.
They're talking about it now, thinking about it and we don't have it sort of factored into our growth forecast per se, but I think it is possible that will be longer before it starts than shorter. And it may, in tougher times, it might take them longer to push the button on the go for that potentially. But look, there's so much recurring business in what we do day to day. If you're a customer for security, whether that's access control, keeping the doors of your business open and knowing who's in your property and out of your property through the day and then having it monitored at night, that doesn't stop. The economy actually doesn't stop it at all. You need that to work. You need it serviced, maintained, and you're interested in using technology to do it better. So I think we're pretty robust. I was an investment professional myself for a long period of time prior to this job, and I can tell you I haven't spent any time worrying about the share market or the economy in the last 2 or 3 weeks.
Awesome. Yeah, probably we'll get more into your background at the end with my questions, but yeah, I think that's a very interesting thing. Actually, next question is: are there any more acquisitions planned, and how do you plan to fund them, if so?
Yeah. So look, we're very clear that we are trying to build out this footprint, and what we are seeing is the footprint. As long as we've been very lucky, we bought quality long-term businesses at really attractive prices, and so provided we can still find those, and they fit strategically into a growing footprint for us to bring us more work. We're very comfortable and happy to pursue them. They're not really difficult businesses to buy, frankly. Um, and yes, there are more of them. So there's quite a pipeline of those type of businesses, and I think it makes sense for us to do them whilst we are seeing incremental work. The last acquisition we made was called Kobe, based in Queensland. Since we have acquired them, they've actually won work that they've never been able to win before, bigger work, higher quality work, because of being part of our group. And it was really the effect of both coming together, not one or the other. It was both. So we'll continue to do that.
Right.
How will we fund it? We've refinanced our debt. Our bankers were very comfortable to lend us funding for growth, debt funding for growth. We don't intend to gear up, so we have to be, very focused on the value we pay. We are generating cash as a business, so
Mm.
the network extension acquisitions, I don't expect us to really require any equity capital. And so I don't think we need any equity capital, frankly, at all. If the market's shut today and we don't need to buy anything, or even if we buy, some small businesses, and small business might be $6 to $12 million type of acquisition price, then we have no need for extra capital. I think there are a couple of potential strategic questions, which would be larger players or peers that may make strategic sense. Not all of them do. Like we've talked about a couple of businesses, but not all of those would
Mm.
be ones I'd necessarily want to buy. They'd be welcome
Yeah.
to buy us if they wanted to. But if we needed to do something bigger, and by bigger, I'm talking about a $50 million to $200 million type of acquisition, then yes, we would need to raise equity. There's nothing likely or imminent at the moment, but we do keep our eyes open for it. Fundamentally, we've seen more. We have no demand problem. Like we have a lot of inbound inquiry now of large scale into what we're doing. We're being invited to either tender or talk to customers, of quite large scale. And I think a lot of that is because our profile is rising and risen. So we've recently made the ASX All Ordinaries Index. We're in about the top 800 companies by size in Australia, which we view getting to the 300 as strategically sensible for us, because we think it will open our profile, right up fully, and be good for investors as well. And so, if we find the right acquisitions that make sense, that don't put us at risk, that we can finance, we will continue to do them. It's part of our strategy for the time being, anyway.
Right.
But I am clear though, David, we don't need
Gotcha.
to. We don't need to do anything. There's no we've got to buy stuff because
Mm.
we've got to do it. Like we're now at a point where this business is now growing itself at good returns and generating cash. We don't need to get out of bed and run it sort of everything. We can be patient.
Mm. Gotcha. Yeah. So I guess this is somewhat of a follow up on that, because look, like acquisitions always kind of mud the picture of the financials and accounting. So this question asks Dennison, when can we expect IMG to report real free cash flow figures without any adjustments? What steps are being taken to provide a clear picture of the company's cash generation capabilities?
Yeah. There's been a couple of reasons for that question. If you look back over the last year, and the first one was the ADT acquisition itself was very financial. The P&L was very messy because they used to capitalize a lot of things, and we weren't able to remedy that until after the first year of ownership. And so it made the P&L and the cash flow
Right.
look a little different. Now we look, the first half result we delivered was actually pretty clean. Actually, if people look at it with fresh eyes, outside a few costs of acquisition, and refinance. The last payment to JCI for the ADT transition, which is now ceased and gone, so we'll never have that again. And a few redundancies as we've improved the business. Moving forward, actually the biggest impact we had was that one point about some of the smaller acquisitions, which had affected our cash flow timing. Unfortunately, that can happen in the short term, depending on the cycle of the cash flow of the business you buy and where it's at in its quarterly billing cycle or payment cycle. You can have a variation for about 6 months before cash and profit equate. And that's just a feature. Look, if we don't buy any more businesses, that will not happen anymore. I guess we'll see. I'm not going to run the business to provide a result. We'll run the business for the right decisions. But yeah, if we don't actually end up buying anything, anytime soon, that will stop. The abnormals now moving forward, we've got, as we disclosed at the half year result, the refinancing itself generates a write-off that we'll have to take through the P&L. And it did cost, there were some cash costs to that refinancing. So unfortunately, the quarterly cash flow coming out probably at the end of this month for the month of March will still have a lot of refinancing costs in it. But I think, we'll clearly identify those and explain them. And then, so really this last quarter for the year, sort of, which will be March to June, all else being equal, should be very clean. We don't have a lot of one-offs planned or anything. We've no real restructuring charges and certainly if we did, they're relatively, very small. So unless there's an acquisition, the refinancing is done, we're actually pretty clean. So I think that the fourth quarter cash flow this year will be the first truly clear, clean number that people can look at. But I do view that first half result, though, if people look at it kind of clearly and fairly as a standalone number and then use that to move forward, that is actually a good base for us.
Got you. Yeah, that's very helpful. So obviously, with all this turmoil about the tariffs, we can't go past this interview without talking about it. So I'm just curious, how exposed are you to this situation? If you have any exposure at all?
It's interesting. We are actually. The reality is most security products come from either Europe or Asia. So in terms of the cost of goods sold, inventory, what we pay for our product, definitely, exchange rate can have an impact. Interestingly, our video guarding technology, ADT Guard, Signature Guard, that we hopefully will be announcing the exclusive distribution of that technology in Australasia for the next 2 years with extensions. That does come from out of America. A lot of the hardware for that comes out of China, but the smarts and the technology and the software comes out of America. So, we may see an impact. I'm not really sure. That'll depend on how it plays. But I mean, truthfully and largely, I don't really see an impact for us at all. I think it's pretty much business as usual for us. Frankly, one interesting side point I would make is that, again, if you go back to the M&A piece about the full structural, the structure of the industry in Australia, there still are a number of large international players who have what would be very non-core operations in Australia that are based in America. Should they, see the world change and decide that they, it's not core to them anymore, which is possible. And I am seeing a little bit of this. It probably does chuck up some very cheap or much better valued M&A opportunities, which might be one in a generation type of opportunities. So we are alert to that. I think what this environment, in my mind, speaks to is definitely much more focused on a local provider. And so, from our point of view at IMB and IMG is, we make a lot out of the fact that we are the local, Australian, New Zealand security service company, and we are here to service, the local customers, the local businesses, and the big ones as well. Particularly the big ones. As their local guy, we're not necessarily offshore owned, and we're certainly not, controlled, say, by the Chinese government or anything like that. And so, we're really pulling hard into that trust piece, which resonates a lot with more and more and more, but has always resonated with customers. Yeah,
makes sense. Yeah, that's great. So I have here a very hard question, but anyways, I'll have to ask it. Can you explain what steps IMG is taking to improve transparency in financial reporting and communication with stakeholders? The AGM guidance and the capital raise before updating the guidance are examples where improvements were needed.
Yep. No, look, I think I'm always happy. I'm always happy to take that on notice. I mean, I think there'd be a fair criticism for us around the capital raise last year, where we said we'd give guidance around the AGM, and we waited. We paused, thinking we were only going to be pausing for a very short period before we gave full disclosure a day later. And then, unfortunately, that didn't transpire that way, which I regret, and certainly wasn't something I'd want to do again, nor necessarily have total control over either. But I think our approach is to be open. I mean, we are a very open business. We're very happy to talk to investors and take calls. We've set our marks for guidance. I think we understand the importance of that. I think maybe deeper in that question is a little bit around the transparency within the business itself. Look, the fact of the matter is there's been a lot really going on inside the business. So if you pick on the Australian business, whilst we were going through the 3G, well, firstly, we didn't have access to our own ERP system for the first 11 months of having ADT. So it was difficult to be super transparent when, frankly, I didn't even really have the information, and we were having to run the business, bottom up for a long period, and with cash, right? Like, we were very focused on cash movements, but that was we knew that was going to be the world when we bought ADT, and that was the world for a period. So it made it hard for us to be particularly open. I think now I'm focused on setting our key drivers and understandings of the business for people, so we can start to build people's understanding of it, and then we can start to work out what is the best way to disclose that story going through time. Look, the reality is there's only a few drivers for our business. So there's sort of number of customers. So in the commercial side of town, it's how many big customers do you have, and what's the sort of value of that customer, and then how much of that's recurring. And then on the monitoring side, it's really how many customers do you have and what's the average sort of revenue or profitability of each of those customers. And I think our goal is really by end of financial 26, we'll be in a shape to be able to provide a lot better disclosure around that that's meaningful. My concern with information is, we're absolutely happy to be fully transparent, but there is some information that I don't think would be that helpful. I think it would actually cause people to not to understand worse the story than better the story. So, we're working towards a common and consistent framework that will help people, not actually confuse the issue. So look, but before we put out our results, for instance, I always give them to an investment bank, and I do socialize them with one or two other people to make sure, to get feedback on whether our messaging is right. If we're doing it, we're not operating in a vacuum. We're certainly not trying to hide anything from people. We are trying to build a long-term, enduring, leading business. Whilst every quarter is the building block of that, so we don't take it for granted. Ultimately, what we are focused on is creating a business of a lot of value over the next couple of years.
Gotcha. Perfect. Yeah, I think that already gives a bit more color on that topic. So another question I have here is, do you plan to gradually convert residential customers to guarding? The unit economics seem much better, and the time frame appears to be a 10-year plan.
Yeah.
Not
No,
sure
no.
what the 10-year plan means, but yeah.
Yeah, I don't know about 10-year plan, but yeah, no. First point, absolutely. So, the really key part of that question, which is absolutely right, is the unit economics of guarding are for about 4 times greater than a standard monitored customer. So, to give you a basic feel for that, in a residential setting, currently we get about $2,500 cost for install and about $40 a month for monitoring. With video guarding, it's about a $4,000 equivalent install, and we're charging $120 a month for monitoring. The cost difference of the monitoring is $18 for the $40 of monitoring and $25 for the $120. So much higher margin, but also much greater importance to do it well. Like, you have to do the service really well. You can't, you won't get away with a average service. It has to work, right? Otherwise it doesn't have value. So the unit economics are much better. I think that's a really key point. In terms of our existing customer base, we've started to do that now. So we've been out starting to tap small cohorts of our customer base and talking to them about upselling it. We're having success with that. The reality is, though, a lot of the ADT customer base, which forms up quite a lot of our customer base, was actually sold to under JCI era at very low value. So JCI subsidised those customers heavily, and so they don't necessarily value the guarding product, they don't necessarily maybe have the money to value the guarding product the right way. So most of the growth we're actually seeing so far is out of either large corporate, industrial, and higher wealth customers who are just happy to pay, who that sort of money doesn't trouble them. So really good question though.
Makes sense. Yeah. The next one is also a good one. How are you thinking about capital allocation, and how has the strategy changed since you took over as a CEO?
Yeah, I think the first part of the strategy when I took over was drive cash flow. And actually, again, I recognise that doesn't necessarily come across because of the accounting noise and things we've had. But, we've been driving the business for cash since I took over and cash returns. The capital allocation hasn't really changed at all. I mean, we've been very clear on trying to set the expectations of not just the stock market, but the actual market for security companies, that we haven't paid above 3.5 times EBITDA effective in our hands, and we're not keen to do that. So capital allocation, I think now that we've done the debt refinancing, we're in a position to start to look at competing uses of capital, and by that I mean buybacks firstly, to maybe dividends down the track. The issue with dividends for us is we have a lot of tax losses, and we have in Australia there's a franking credit or an imputation tax regime where you get to pass on the tax paid by the company, and because we don't have that, the dividends are relatively less attractive to an Australian shareholder. So it's less likely we would do dividends until we pay proper tax and generate franking to offset those dividends. So buyback is your best option at the moment. Notwithstanding, we think we are very undervalued compared to our global comparative companies. We're still trading much higher than what we can acquire companies for. So, I think at this stage we're still focused on growing our footprint and adding value to the business than necessarily returning capital to shareholders yet. But happily, we are seeing cash flow coming through the business now. Having come from where we've come from, they seem like pretty big numbers on any given day, but are what you would expect. And so, I think we need now to sit, for the next 6 months to year and just assess, make a proper call as to what the longer term capital allocation strategy should be. So it's something the board hasn't got deeply into discussing yet. I think the reality is we do have a pipeline, we do have opportunity. We're also trying to accelerate our growth. And so, using capital and investing in the business right now, we really do think there's a significant opportunity here. So, we want to make sure we don't, underinvest, and given we've got what we think is a lead in the industry at the moment and a good market position to start from, that we don't do full service to the growth. The returns are very strong, the incremental returns. So, we should be prepared to invest against it.
Makes sense. Awesome. So yeah, this one is also a good question. How large is the portion of your revenues recurring? Is the remainder also somewhat recurring?
Yeah, I think so we generate about $6.5 million a month, which is just purely recurring monitoring revenue. So that's maybe $80 million a year of recurring revenue. On top of that, the balance, we're now generating sort of $5 million a month of commercial enterprise work, which is well, in Australia, and probably there's been another maybe $1 million or more in New Zealand. A lot of that is what I would call recurring too. So in that work, you're doing more access control, video, sort of analytics, integration work. The reality is, like a commercial enterprise customer, again, if you started fresh today with nothing and you put in a new system, the rule of thumb is you spend about 20% of that value of that system every year just to maintain it, to make sure it's working and probably to keep it up to date technologically. And so, and it's probably another way of saying that within about 5 years, technology, has moved on such that you need to replace what you've got. And I think that's probably conservative, actually. So, a lot of our business is recurring. We probably have only 2 customers that I'm aware of, and they're quite large, that we're currently putting down new sites. So they're growing their footprint very fast, and they're quite big footprints. So that is positively, growing us. That
right.
Is not necessarily reoccurring at that rate. But I think that would be, of our current revenue today, it might be maximum 15% of our revenue. So it'd be maybe 10 to maybe 15%. I think the rest of our revenue is largely reoccurring.
Okay, I will jump in because I have a question that isn't in the questions written here from the audience, but I think it's interesting. So what you said, it's basically you are also growing alongside your customers in some way, right? So isn't it also a kind of reasonable strategy to look for high growth customers? For example, customers that are growing sites at a fast pace and you can scale up with them. So interested to know what are the unit economics there and so on.
Yeah, no, good question. Look, it is and it isn't. So, one of our fastest growing customers is a data center company that's growing rapidly in our part of the world. And, this year it will provide, a good portion, maybe 10% of our incremental growth for the group. And it's millions of dollars of additional work, and they've got a lot of growth to come. Like, they're looking forward a couple of years, and they're fully funded, with cash in the bank to do it. The challenge with that work, though, is it's very competitive. So if you've got someone who's putting down new sites, what you find is that's where competitors try to come in and get a position in the industry or compete. So, you could expect, Securitas, for instance, or Convergent, or somebody, Chubb, to all bid for that type of work. And so what you find is it's our lower margin work, is that really fast growth work. Now, obviously, if you do a good job, it's fine. What we have found to be successful is where that pricing goes below a threshold. And I'll be upfront today, we drew a line on our pricing for a piece of work like that and said we're not prepared to discount past this point because we're going to maintain and hold our margins. We know our value. What we've found in the past is where people have come in and bid low, they've actually lost money in this work, and quite substantially can lose money. And we have been called in to fix it. And so, we're quite comfortable being seen as the quality provider in the industry, that, we charge a very fair price for what we do, but we provide a really high quality, reliable, robust service that works. Because, the way I always put it, right, is if you are Sydney Airport and your security system or access control goes down and your doors don't open and all your passengers are standing outside because you've got a system fault, like, that's a major problem for you. That's not, and it sounds like, but it's just access control. It's like, no, that's really
Yeah.
serious. And so, they need it to work, and they need it to work every day, 365 days a year, and they can't have it go down for any more than, in their case, it's an hour. 1 hour is the longest we're allowed to let anything fail before we've got to pick it up. So, I from a growth point of view, look, the reality is, cameras technology's moved a long way in the last 5 years, from analog to digital to high definition to now with smart cameras with speakers and signals in them, and a whole lot of evolution there. And so customers are really, only now starting to think about what they can do with that and what information they can get out of that. And that's driving I think will drive a lot of replacement and upgrade for a long period of time, actually. The other thing is access control itself. I think access control's gone from literally being the fob, and I'd imagine most people have this. I'm sure around Europe it's the same, where you have your card to swipe in on the door and get in the building and out of the building. Well, that world's moved a long way too now. I mean, obviously now you can phones and watches, but that information can be used better and, can actually go into and be integrated into businesses' operations in a different way. And so, there's very, very, very few customers globally, I can't think of one, that has optimized access control and security fully to its highest use yet. And so, our mission as a business is to try to really push the envelope on getting the best outcome, productive outcome, and safe outcome for our customers that really helps improve their business. And, we haven't yet got a model customer for that. They're all at various stages.
Yeah, got you. So yeah, Dennison, you graduated the questions from the audience. Congratulations. And I don't know how much time we have left, but I would like to ask you some questions from my side.
Yeah.
So yeah, the first question is actually a bit more on your background, maybe also childhood in some sense, because I feel like those early years always shape you into who you are today. So yeah, just curious to know a bit more on what you can share about that. Maybe.
No, absolutely. So look, I'm a New Zealander originally. I'm an Australian citizen, so I'm a citizen of both countries. I grew up in a small country town, effectively in New Zealand, as a family multi-generation business. So for a very young age, I was very interested in business, such that I left school early and went to university early and got a master's in economics degree, honours from Auckland University. When I was young, I was a very good swimmer. So at age 9, I won my first New Zealand record swimming and represented New Zealand up to just under Olympic level. And so I've always been very focused and I suppose people would say very driven. I'd like to think I do that in a very human way. Like the joy of this job that I have right now is we're, approaching 600 employees. And, this was an industry that was not loved, that had been left behind, that didn't have, a leading player that was actually trying to do really good things for their customers and for society. And I think now what gives me a lot of pleasure is our team is really excited about coming to work and what they're doing and the customers we've got and the services we're providing, what we're doing. So for me, whilst I'm very focused, I like to think I'm helping being part of a team as well and building a proper team. I got a lot of pleasure. I've got 3 children who are all getting older now. So 19 is the eldest, turning 20 next week, through to a nearly 15-year-old daughter. I've enjoyed being a coach of sports teams through that time. And again, that's because I really like what I've said to my team at IMG, and I say it to all my sports team is, first job is to get into the championship. At the moment, we've got to get into championship shape, but don't make any mistakes. I'm not here to win 1 championship. I'm here to win 5. like we're building a great team that can survive and can endure and can go on. I think, one of the early books, I've been a big reader. I love business and investing. It's been my life, outside of, it's been my professional life, but a big part of my life, which is for most investors. I think the Good to Great book, in hindsight, I knew it was a good book at the time, but I think now I'm in this role, it means a lot more to me. What I've moving out of the investing world, where I had investing rules around, what I needed for a good investment, and what are the attributes of a good investment. Now I'm also focused on what are the attributes of a great company, and so for me, when I'm gone and dead, and as will happen to all of us, what I'd like is that we've built something that's been meaningful and enduring. And the only way you can be enduring is very commercial. Like, you have to add value. You have to have a really solid place in the world, a reason to exist as a business, and to have your customers, want to come back and continue to work with you and pay you for it. So yeah, I'm very, very happy to have the opportunity here.
Cool. Awesome. Actually, I'm also curious on your transition between, I guess you were in private equity, if I'm not mistaken, or whatever investments, to actually being a CEO, because I bet you had to learn a ton of new things about the industry and all that. And yeah, so just curious how that transition was and what actually motivated you into, besides the financial incentives, obviously, but yeah. Just curious if you could explain a bit more on that.
So my journey was, again, left school early, got out of uni early, did a full degree, got into professional investing early. I'd started my investing career just before the tech boom and bust. So I got a really good experience in markets ups and downs very young, and we were managing a good amount of money. The firm I was running, we had $500 million under management and a very small team, and we're very directly responsible. I then went on, and effectively the next big turn was I built a wealth management business out of Melbourne, Australia, for 13 years. That went on to be very successful. In that business, I was the CIO, and we did a lot of direct investing. So turning around businesses, debt, equity, structures, and got more and more involved. Got out of that in 2019. And I got out of it because it wasn't going to be somewhere I could probably see myself being able to spend the next 20 years of my career. So I needed to get out and figure out sort of where life was going to go. And at that stage, I had a little bit of money in my pocket and could make more decisions for myself. This situation actually started, or IMB started, because from an investment era, and I say that to people quite openly. The Threat Protect business, which was the name of the business before we took control of it and got it going, was a failed roll-up. And I do say that to people quite openly because, I know what a failed roll-up looks like, and I've invested and I've seen them before. And that's why our acquisition strategy is very careful. Like, we're not going to just buy a whole lot of stuff just to try and get big really quick and then blow up. We are building a business. And so, 2019, I was involved with another listed business, built up some assets, and ultimately I ended up here. It was a phased arrival, David. So I started as a non-executive board member, and I realized that I thought, having seen a lot of businesses in turnaround, like the skills this business needed were probably the skills I had. I just didn't have the technical understanding. And so that's been slow to develop. And to be frank, it's probably been an advantage. I think not being locked into old systems and strategies and how it's always been done. The feedback from the staff and the industry to me has been, it's actually been really good to have someone fresh come in and actually have another look at this. So it's been interesting. It is a different skill, and it's much more around people. It's more like being a sports coach. Than being the star player. Star player. You're as an investor, you're the star player. As a manager of a business, you're really a coach.
Right. Makes sense. Actually, you go into the business with a beginner's mind, right? Because you have to learn everything from scratch, and that's a concept I really like. So also, I guess, we can't talk about IMG without mentioning Peter Kennan,
Yeah.
the biggest shareholder, and I guess you also knew him from back when you were like in the investing business. So just curious to know how that relationship developed and what is his role in IMG. Like, is he active in the decisions? Does he? Yeah, just
Yeah.
curious to know a bit
No,
more
no,
about
that's
that.
fine. So I met Peter. He called me one day on the telephone. I was invested in a hybrid bond, so really debt like equity that was listed in Australia. It was trading at 10
Hmm.
cents in the dollar, and I'd been in the front page of the business paper in Australia because I own 19.9. The business my investors own 19.9% of it, and I was shaking the tree a little bit in the company. And Peter rang me up and said, "Oh, I see you're invested in that.
Hmm.
I've got an investment in that too. Would you like to work together on trying to improve this?" And I said, "Yeah, that'd be great." So he had an investment in it, and we worked together. And it was called the Elders Hybrid, and we got that back out to a dollar. So it was 10 cents in the dollar, and we recovered it to a dollar. And that was our first co-investment. Shortly after, he rang up, and we ended up in another investment together, and we recovered that. It was about a $16-17 million of asset business that got up to about $1 billion again on the recovery, and that was a lot of M&A and restructuring to do that, debt restructure, a whole lot of stuff. So we'd known each other as co-investors for probably a decade before IMB. I ran into Peter on the street in Sydney when I was out trying to help Threat Protect raise a little bit of money to get them through what looked like a working capital short-term problem. And I ran into him, and I said, "Hey, have a look at this. It's very small. No one's going to care or know about it, but it looks relatively simple. If we just join, maybe we could join the board for a bit of fun together. No one's going to care. We don't, it's not particularly big, and we'll just see how it goes, and it should be fine. And we'll sell it in the next 12 or 18 months. We'll get
Yeah.
we'll do a private equity sale or something." And that was the genesis, and that was late 2019 and into 2020. And then I think what really happened was, one, it was worse than we thought, so there was more work required, and that was just that happens. It was, as I say, an error, but luckily the thesis we had was right, which is it's a very stable business and it does generate cash flow, so the risk on the downside was still protected. What really happened though is when we got in there and started to look around at the industry, we went, "Well, this is actually a much bigger opportunity than we had actually identified initially." And so, there's probably a lot of ways we could develop this. And at that point, I decided, Peter lives in Geneva, and so it was sort of I felt like it was the right time for me to do something more serious, that more time consuming, and that I was happy to get involved. In terms of how we work now, Peter's the chairman. I'm the managing director, or CEO, as you called it. So, we had regular board meetings. I talk to him very regularly, so probably at least once a week we'll have a catch up. He's very engaged and knows, nothing major happens in the business that he doesn't know about straight away. And yeah, his counsel, I think we've worked well together, in that, we're different people, but we've got a similar objective. And, we've both been around long enough to not get distracted, is probably the best way to put it. One of the surprises or things I knew, but, I guess it's been highlighted to me, is being a listed company CEO can be very distracting. You can get very, very distracted very, very quickly and lose your priorities very, very quickly. And, one of the things,
Yeah.
one of the things we've been lucky about is because Peter and I both have, have corporate finance investment backgrounds. What we don't have is a whole lot of bankers crawling all over us trying to tell us that they could bring this deal to us or that deal to us, because the deals come to us naturally through the business anyway. So, we've been able to keep the financial markets distraction to a minimum. That's why I can spend the time talking. I just want to talk directly to the investors, to people like yourself, so that you can have a stake in the business and understand what we're doing. And if the feedback loop is there, I'm very comfortable to be criticized, to be, given advice and opinion by my investors. I think that's healthy. And I do listen to that. But ultimately, day to day, we're able to be very efficient. And I'm, essentially left to do their job. And if I'm not the right guy, then the board, can tell me to move on, very quickly, and I'd do it. But I enjoy it, and I'm very keen and optimistic that we could build a substantial industrial quality business here.
Nice. Yeah, I was actually about to ask you on how does it feel to be a public company CEO, but I guess you answered that
No,
already.
well,
So,
no,
curious to know what
that's actually a better
mistakes have you?
question. Yeah,
Sorry.
well, that's actually a good question, because I'd sort of answered it, but I didn't answer that directly. Like, I don't like it, to be blunt. I think it's a very thankless world, a bit like being a
Uh-huh.
politician now. And but more than that, I get that transparency is important, but like, there's good and bad. As I say, transparency seems sensible, and it is sensible, certainly in a case where you can't trust the people, that you'd be partied with, but it also comes with a cost. And I don't think that should be lost on people. Like, there is a cost to transparency. It's not free. I think the other thing that we have to bear in mind is, you're going back to your question at the start about who's, leading. I believe we are. But the challenge of being listed now is that all of
Mhm.
my competitors are on the calls, and they're reading everything we're doing, and they're watching our LinkedIn profiles of all my staff. And one of the things I did about 2 months ago is, I've put a non-disclosure agreement across the entire staff at IMB, and being clear that, they're not to make big public comments about what we are doing, the technology we are using, how we are doing things, because, we've got an advantage, and, we've worked hard to get here, and I don't want it to just be handed over, to our competitors easily, just because we are listed. So I think being listed, I'm very thankful for the support. So I don't take for granted having shareholders, and that we've been supported, and, so I do appreciate it. I'm not against it, but it does present challenges that need to be navigated as well. So sorry, I had to answer that, because that's, I think, an interesting question.
Yeah, yeah. I always try to put myself in the role of the CEO, because it's a pretty different job from like a private company CEO, right? Because now you have to, yeah, like give your time to a whole lot of different people that aren't necessarily, yeah, tied to the business, and you can get distracted really quick, as you said. And yeah, I have one question saved for the end, and it's related to this topic, but I like it to keep it to the end. So my next question is actually, what mistakes have you made as a CEO or executive in the past, and how did you learn from those mistakes, I guess?
Yeah, I find mistakes the most interesting. So for me, I'm a downside up kind of guy. So errors are more interesting than successes. I think, in this situation, I was
Mhm.
I found it more challenging than I thought I would, which is probably just overconfidence about putting in place the cultural values that I think are really important. So, we haven't really touched on them today, but I think a successful business has three elements to it, in the culture. One is honesty. So you have to be very honest as a business about what you're doing, whether you're doing it well or not, or where you're going well and where you're not. You need to be transparent. So within the business, you need to be very open. Everyone needs to know why they're doing what they're doing, why we're doing it, get the information they need to do the job. It needs to be very transparent internally. And then you need to be inclusive. So you've got to be able, everybody on this planet is different. David, you and I are different. We'll have different upbringings and backgrounds and what have you. But there's probably more that's similar about us than there is different, and there always has been, and there always will be. And so you need to be able to create a team, and the team's got to pull together in the same direction. And I think I'd underestimated how challenging it is to actually not make people, but to get people to believe in those values, especially when they've come out of a big corporate global business where no one really wants to make a decision, and it's a bit of a risk to make a decision, and you don't want to be wrong, and you don't want to be particularly honest all the time, and all that sort of stuff. So I think that's the challenge of management. Like, it's a true challenge, and I'd probably been more optimistic about my ability to influence that. We're obviously working on it every day, so it's not that I'm not aware of it, and it's something we're really attacking. Outside that, look, there was one transaction we've made, which certainly on paper wouldn't have looked successful, which was buying the Mammoth business back in about 2020, early 2022, I think it was. So we actually transacted it right at the start of the Ukraine kind of war time, is how I remember it, and it was prior to buying ADT, after we had invested in our monitoring platform, and we had a modern platform, and we were trying to figure out how we were going to bring growth into the business and speed up the growth. So we decided if we bundled some product into our customer base, that would be a smart way to try and influence growth. Sort of two things happened. One is it showed us the industry is very slow to change. Like even with a really strong proposition, you can't have a partner do it. You have to do it yourself. So I'm a big fan that if you want to bring change, you have to do it yourself. You can't wait for other people to do it. And we hadn't realized how slow the industry was. The other thing that happened is ADT came along and it kind of made that strategy redundant. And so we pulled back, almost totally from having our own camera, Australian sort of assembled camera strategy to really honing in and focusing on being a service provider and agnostic to technology. And so, it looks like it didn't look like a great deal, if I'm being blunt. It's the only deal we've done that didn't look great. That being said, we learned an awful lot. For a couple of $1 million, we learned a lot about the industry. We learned a lot about ourselves. It set us up really to be the business that we are today, that we are can do. So, not trying to make a mistake sound like a win, but if I had my way, we may not have done it. Probably the other. Sorry, since we're on mistakes, the other one was the way the capital raise unfolded last year. Unfortunately, essentially the market got away from us, and we what for transparency, what really happened there was we were flying high, so our share price had really kicked on. We had strong market support. I had a couple of conversations with smart people I trust and respect their opinion of, who said, look, you've got a big pipeline potential of acquisition. Your refi is still a couple of months away because your current debt providers won't exit without charging you, and you don't want to pay the bill. Since you're in this really strong position and there's a lot of equity available for you, maybe you should take enough equity so you don't have to come back to the market, and then obviously explain that to the market, which we did. And then just sit tight, and you're in control of your pipeline, you're in control of your refinance, you're actually in really good control, and I think the market will accept that. At the same time, just as we're about to go and do that, Peter popped up, which is totally within his right, and said, look, hey, well, if we're going to raise some money, I do need some liquidity this year. It's a one-time customer piece of liquidity that I need. They've been holding off now for some time. I can't really hold them off. I think it would be a sensible time for me to be open and transparent with the market too, and say, hey, I need to just make this one-time deal now. I can't speak for Peter. I'm just reiterating what he has said. And so, unfortunately, quickly with the way that it flowed through, it looked like the market started to play chicken with us for looking like it was a sell down, not actually a positive raise. It looked like a negative raise all of a sudden, and at that point we really lost control, and we had to make the decision whether to go no go. It was finally balanced. We could have decided to just leave it, frankly, and that was very much considered. But at the end of the day, we're deploying capital at very highly incremental rates. We needed to once Peter got into that position, we really needed to clean his position so that he doesn't have to transact anymore, and we wanted to be in firm and full control of the business. So we made it. Was that how I would like things to have happened? No. Did I like it? No. Did I get some pretty unhappy people for a period there? Yes. Has it cost us? Yes, it has cost us in the short term. I mean, we certainly haven't traded back to our highs yet, but fundamentally, we are in incredibly strong shape now. Like, we're in really great shape, and we just have to focus on delivering and getting the job done.
Yeah, I think that kind of information is very important for investors, because you've been on the other side as well, and obviously you always have to be skeptical, because yeah, you never know what's really happening behind the scenes, and
Yeah.
you really have to trust the other people. So I guess, yeah, that helps a lot. So happy that you were able to share that. um so yeah, I have a couple of more questions, and then we can wrap up. So my first one is, what do you fear?
Oh, that's a good question. I don't know. I think I'm getting too old, David. Uh, Oh, look, I think if I'm being honest, well, straight, I do understand that I'm looking after people's money. So I've always been someone who's taken responsibility, I think, appropriately, and I don't underestimate, that all our investors themselves. I mean, I've been an investor. Like, I know you have to report to your investors as well, and you have to explain to them why you're invested in this funny sounding business in Australasia. And there's this guy, and he's got a bit of a Kiwi accent, and he's doing some security things, and so I don't at all, like, I would fear doing something myself that jeopardized people's well-being, health and well-being, if you like, whether that's financial or whatever. That being said, I can't control everything. Like, life is life, and we do have to go through the journey. What I do know, though, is if you get up every day, point forward, and keep going, like, it takes a lot to knock. I'm fairly resilient, so I'm not going to give up. I don't walk away from a challenge, what have you. But yeah, I don't like everybody. I think my basic rule, David, is most people get out of bed to, hope their families are proud of them, to earn enough money so that they can actually provide a decent life for themselves and the people they care about. And ultimately, when they die, people don't hate them. And I think I'm pretty similar to everybody like that.
Nice. Yeah, that's a good one. Okay, so the next one is, who are your role models and why?
Well, I've been really lucky because I've been effectively a professional investor for the majority of my life now. I've seen a lot of business. I met a lot of people, and I suppose I've read a lot of books. Probably, and like on the investing side, I've got a lot of time for Howard Marks and how he built Oaktree. I'm not sure I'd call him a great investor, because I'm not sure how much investing he actually does. But as a business leader and voice for business and sensible framing, I've got a lot of time for that. Personally, I was very influenced by a meeting I had with an investor called Graham Hart, who's a New Zealander, but he's global, and he owns a business called Rank Group, which is Graham Packaging Global. It's about the third biggest packaging company in the world. He's hugely wealthy, successful character, not well known globally. He's got a very low profile. He had turned around a number of big businesses in Australasia, prominent big old businesses, and was a very private guy. And I got to meet him as an investor in a co-deal, and got to spend time to understand how he worked and how his team worked. And it formed a lot of, it actually formed quite a lot of the base of my thinking about being a manager, certainly bringing change to a business, and how fast you can bring change and how fast you can affect success. And so, I'd definitely put him up there as somebody I'd admire how he's gone about building himself. Yeah, and then look, I'm lucky I get to spend time with a lot of successful people. I am lucky having looked after money for quite wealthy business owners and people. I've seen a range of people through my time that are very impressive globally. Been successful. So it's hard to pick. Outside those would be the two sort of standouts. I'd say actually James Montier, I got to see speak at the London Value. I went to the first London Value Investors Conference when it first started. It's probably going back now 10, 15, 20 years ago. And that first conference had Howard Marks, James Montier, Richard Oldfield, I'm trying to think of some names, present, and it was fabulous. And I I always thought James Montier's book Behavioral Investing was probably one of the best investing books I've read personally, and took a lot from around just the behavior of investing and the behavior of people. So yeah, not sure if that's a helpful list for you, but there'd be some.
Yeah. Yeah, no, it's always interesting because you're really like the average of the five people you spend the most time with, and sometimes we spend more time with our like mentors that are distant, right? So reading and watching interviews and whatever. So I
Mm.
feel like that's a very interesting set of people.
Well, I would
My last
say,
question is how often do you sorry, yeah.
oh no, sorry. I was just going to say, I would also say, I think in today's day and age, one of the things I've learned as I've got older is sometimes you don't want to meet your heroes because they can be disappointing when you do actually meet them, and they
Yeah.
may not be what you expect. And I've never gone to Omaha. I'd have to say, whilst I've got a huge amount of respect for the philosophy of investing that Warren Buffett has created for everybody, I do find it a little bit over the top. The way people, have overanalyzed his short-term thinking, whatever. I think he's got some fabulous long-term lessons and characteristics, but I'm not sure it's as deep as maybe some people would like to think. But that's again, I'm glad in a way not to have met him, so I'm happy with that. But anyway, sorry, David, to cut in there.
Yeah, yeah, no worries. Actually, it's interesting because I'm reading Thinking Fast and Slow. I don't know if
Yeah, Daniel Carmen.
you
Yeah,
ever read that book, but
yeah.
it's yeah, it talks a lot about like the role of luck and just like randomness in stories. And when you get those mental models in mind, you kind of always tend to discount like these extreme successes because yeah. But anyway, like he's a great role model, and obviously I like him a lot, and
I,
like
I,
yeah,
I
it's
have
a role model to a lot of investors.
I think I've certainly found that people massively over or under appreciate the role of luck, particularly in investing. And so, one
Hmm.
of the things I learned even in watching myself, and I say this like my worst investments invariably came directly after my best investments. And when my confidence was too high and I thought that everything I touched was good and I would be fine, and I knew what I was doing and I was at, and so
Hmm.
I think a lot of self awareness, a long. I think there's a big difference between investors that are around for 3 to 5 years and those that are around for 20 years, 30 years, 40 years. And I think a lot of it is self awareness, in
Hmm.
terms of, they don't over or under appreciate luck, and they probably over appreciate the value of hard work and discipline and focus. And so for me, one of the key words in business and life is focus. Like it is actually you've got to display to be
Hmm.
truly successful, either in investing business or even life, and family and relationships. Like focus and intentionality are very, very important. It doesn't mean you're not going to have hard days or things won't quite work out how you like, but it does improve your chances of success if you can have focus and intentionality. I think so. It would be an observation.
Right, right. Actually, before the last question, I'm just curious. How do you manage the emotional roller coaster that comes with the like investing and business in general? Because I guess that's one to the point of the book, behavioral investing. Like that's one of the key differentiators between like long-term investors that are able to thrive throughout decades and so on,
Yeah.
and like investors that might have a good run but then yeah fall off. So maybe that's also an interesting topic.
Yeah, well, it is really interesting. I mean, I think, and certainly I can apply this to IMG and running a business. You can only control what you can control, so you can control the inputs. And I always say, like through the journey, when Peter and I have discussed
Mhm.
the decisions we made and what's going on, and we've always discussed, is it a good business decision? Because we can control the decisions we make, and whether they're quality decisions, with the right things. We can't always control the outputs or the outcomes, right? And so, one of the things that's become, clear to me is we're building the business based on the inputs and understanding like the productivity of the employees, the outputs we expect on average, the accountability, and then the results will be the results. And so, one of the things I've found hardest as MD is when you sort of get into forecasting and like forecasting margins and things like that. Like I can do it and I'm happy to do it. But the reality is, we're driving decisions on the ground every day today that will affect in 3 months and 6 months and a year's time. So, we have to focus on what you can control. And so same for investing. Like I always, personally thrived in tougher market environments. And, when people were, particularly worked up, I found that was a time to become very calm and just focus on the things that you could control. And even if you were very underwater or something wasn't right, you've got the opportunity to do one of two things. One is to do something about it, or probably most of the time do the second thing, which is the best thing to do, which is nothing. And one of the beautiful things about investing is it's you are actually paid, and sometimes and more often than not, the best thing you can do is nothing. Which is an unbelievable thing. And I think one of the challenges in professional investing is people feel like because they're being paid every day, they should do something. So there's a crisis, something's changed, I've got to do something. When I think if we could analyze it, and this is why I like James Montier's work, like I think you'd find more often than not, the best thing to do would be to do nothing.
Yeah, for sure. I have one more question about what you said, and it's actually on forecasting, because I've read several books on forecasting and like how experts actually fail to be good forecasters even in their like area of expertise. And so what have you learned about forecasting now that you are actually managing the business, because as an investor you always feel like
Look, I'll give a completely unsatisfactory answer to everybody listening, but I don't like it when people spend a lot of time in the business forecasting forward for long periods of time. I feel more confident forecasting out 3 years than I do the next year. Like that's the reality. I've always found, certainly with markets too, like actually it's easier to forecast if you're prepared to go out a bit further. And so again, I go back to what we can forecast as the inputs and go like, if we have this many staff and they're chasing this many jobs at this kind of margin, what does that mean our results should look like? And you can get pretty close, but I built a business up over 13 years, a private wealth business, and it used to frustrate me with how long the CEO of that business would spend forecasting every year. And every year the market would change the forecasts like within the first day of the new year. Like, so I think for me, the process of forecasting is important because you get to understand what the drivers are that you can control or focus on. And as an investor, I think that's as important too, because what I'm telling, I guess, you and the guys listening is, we have demand is good. What we need to meet that demand is we'll need more people. We need them to be productive, and we need to make sure our pricing discipline stays in place. And we know there's a big total addressable market. Like the addressable market, particularly around the video guarding and monitoring, is substantial. So what does that mean for growth next year or in 2 years' time? Not sure. But as I look out over the next 3 to 5 years, we should easily be able to double the size of this business, not buying businesses, just by actually executing the process of driving this business, forward with customers. Yeah. So it's forecasting. I find it difficult.
Yeah. Okay. So last question is, how often do you check the company's stock price?
Look, to be honest, not very often. So usually before I have to present, I'll go and see if
Hmm.
if I should know what the share price is. When we've just bought something or what have you, you tend to watch. People will tell you what it is, but truthfully, I am at the stage where I check on it. Is probably the way I'd put it. Just because I know it's important. Like it is at the end of the day, it may not be so important to me right now, but it's important to you and to investors. And I'd like to know whether people are happy or not. But fundamentally, it doesn't influence my decision making or thoughts, particularly at the moment. Yeah.
Nice. Perfect. Okay, so I guess that's a wrap. It was a wonderful conversation. You were very generous with your time. And yeah, just wanted to thank you so much. And whenever you want to come back and update us on the latest news on IMG and developments, feel free to reach out. Happy to.
No, thank you. Well, we've got implied in our guidance is a very strong growth second half, and then that we expect to continue through. So I think now we're starting to really see the business come together, and that is sort of very gratifying. The rate it comes together and all that stuff, as we talked about, not we'll find out, but the drivers and the outlook feels pretty good. I'm very keen to come back and let you know how we're going, and as I say, I really appreciate the support. I understand it's it's a reach. We are cheap. I think fundamentally, I'd wrap and say, if the market ultimately doesn't value what we've built over the next year or two, we are a very transactable business. There are plenty of people globally who have, I've done a lot of work now globally around the industry and looking at who the players are and who's doing what. And, if in the event that the market itself wouldn't appreciate us, sort of appropriately over the next probably, 12 to 24 months, I don't think we would wait forever to get a return. We appreciate the value of capital. We understand, we've effectively borrowed the money to build a business off our investors, and we'd like them to see a return.
Hmm. Perfect. Okay. So yeah, see you next time.